For this video, I want to go through a sample form 8582, which is the passive activity loss limitations form, and this is going to be for the 2023 tax year. Now, the 8582 has 2 pages, so we'll cover both of these pages, but this is part of the full Form 1040 for our taxpayer, so I'll cover all the other schedules and worksheets that are required. So we'll go over Schedule E Part 2, where we ultimately report this income and loss. And then we have some passive activity loss worksheets, which we'll go through also. Now, I've also got a variety of K1s here. So the taxpayer has 4 separate K1s, 3 passive activities, 1 non-passive. So we'll cover those. And then lastly, I've got just one slide here covering some background on the 8582 and then some more details on the fact pattern. So the 8582 is used to separate and calculate our passive activity income and losses, right? And ultimately what we're doing here is we're trying to figure out how much, if any, of our passive losses we can use to offset our other passive income, or in some cases, our other non-passive income. So what is the big difference between passive and non-passive activities? Well, passive activities are active trades or businesses in which you did not materially participate during the year. Passive activities also include rental activities. So rental real estate activities are per se passive. So it means it doesn't matter really how actively involved you are or you think you are, it's still a passive activity. Now there are special rules, right? There's real estate professionals have some special rules where it can become non-passive. And then there is that special allowance available to certain taxpayers where they can deduct up to $25,000 of rental real estate loss against their non-passive income. Now, when we talk about passive activity losses, they cannot be used to offset income from non-passive activities. And that's what we're going to see in our example here is the taxpayer needs to separate these items, use passive losses against passive income, but that non-passive income has to be separately stated and can't be used. Now, losses are freed up in the year you dispose of an activity. So a common question I always get is, well, I have all these suspended passive activity losses. What if the business never makes money? Well, unfortunately, if it never makes money, that's not good. But if you do ultimately dispose of that investment, then the losses are freed up. They're basically recharacterized to non-passive losses, and they can offset non-passive income. Now, we don't have publicly traded partnerships in this example, but I want to highlight that PTPs get treated separately from this. So publicly traded partnerships, it's a passive activity to you, and that you're not actively involved at all in the operations, but they are not included on the 8582 as a passive activity. So they're actually separately stated. There's other worksheets. I'll have other videos covering how to do those calculations. So in our fact pattern here, we've got John Taxpayer. He's the managing member of Active Business, LLC, and he materially participates in the business operations, right? So that's going to be a non-passive activity to him. Now, during 2023, John made 3 investments of $5,000 each into partnerships where he's a limited partner and he does not participate in the business activities at all. Now, none of these entities are PTPs, and that's important because those would be treated a little differently here. John has to complete the 8582 and Schedule E Part 2 to report these activities, and we are assuming here that John has sufficient outside basis and at-risk basis in each partnership. So, in other words, we're not going to be limited to taking losses because of basis issues. We are suspending losses because of the passive activity loss rules. All right, so let's have a look at a sample K1, and then we'll come back to the table because I think the table summarizes everything a little better. So this is one of the investments that John entered during the year. So you can see here that there's a line 1 ordinary loss of $3,000. There's some interest income of $5. And we can see down here in the capital rec that John put the capital in, allocation of loss, ending capital account. So he's got sufficient amount of capital into the investment. And then the same goes for all these other ones. So this is Partnership Fund 2 LLC, $1,000 of income, $3 in interest. The third passive investment Partnership Fund 3 LLC, a $150 loss. $16 in interest. And then we can see here the active business LLC. We have John Taxpayer. He's a general partner LLC member manager. And we have $500 of positive amount of ordinary income and then $7 of interest. And so when we look at this table, we've summarized all the activities here so we can get a sense of kind of the big picture. So we can see here that overall all of these operations made a total loss of $1,615 on the line 1 ordinary income side. So what a lot of taxpayers will think when they look at this and say, oh wow, look, I've got all of these losses, I'll be able to wipe out all of this income and I won't have any taxable income from these pass-through entities. Not going to be the case, right? Because we have to separately calculate the non-passive versus the passive activities, and certain items of income don't get included in that calculation, like we'll see with the interest. All right, so let's start with the 8582, and the 8582 again. So it's 2 pages, but you want to start with the second page. All right, so notice here, so if you have real estate activities, you might be completing lines 1A through D, but in our case we don't, so we're moving on to 2A for all other passive activities. So it asks us activities with net income, enter the amounts from Part 5, Column A. So Part 5 is page 2, so that's why you start with page 2 and then you go backwards up to page 1. So Part 5 is where we list all of these passive activities. So notice that we are listing funds 1, 2, and 3. We are not listing the activity from that active business because that is a non-passive activity. So if it's not entered on 8582, where does it go? Well, the active business is entered just directly on Schedule E, Part 2. So we can see we've got it listed there on line or row C. We have our active business LLC. It's a partnership. And then row C, we have in the non-passive income and loss section our $500 figure. So the Schedule E Part 2, for our non-passive activity, we just listed it directly here. But for our passive activities, we have to start with the 8582, and then we come back to the Schedule E Part 2. So we're looking at Part 5. We've got each fund 1, 2, and 3. Current year activity, we have positive amounts of net income. Line 1, ordinary income of $1,000 from Fund 2, and then Funds 1 and 3 have the losses of $3,000 and $150. Prior years, we have no unallowed losses being carried forward, so our overall gain or loss are the following here in columns D and E. Now notice what's not included in this computation. We are not including portfolio income. So line 5, the interest income flowing through from these investments, these are not included in that passive activity or passive income or loss calculation. It's just that line 1, ordinary business income or amount. So the amount of portfolio income is just reported directly on Schedule B. So on Schedule B for our interest and dividends, we've reported the flow-through amounts there, but those values are not included in these current year net income or loss calculations. All right, so now once this is done, then we can go back to Part 1, lines 2A, 2B, and 2C. So if I go back up here to Part 1, where we're not doing lines 1A through D, so we have 2A, there's our $1,000 positive amount of net income. Line 2B, $3,150 of losses, and 2C is blank because we don't have any prior year unallowed losses that are being carried forward. So we combine all these amounts and we're left with a minus $2,150. Now in line 3, it asks us to combine lines 1D and 2, so we've done that. And then after line 3 is completed, we read the following prompt and it asks us, okay, if line 1D is a loss, right, 1D is blank. If 1D is a loss, go to Part 2. If 2D is a loss and line 1D is 0 or more, skip Part 2, which is that special allowance for rental real estate activities, and just go to line 10. So in our case, we're just skipping Part 2 because we don't have any rental real estate activities with active participation, so we're going down to line 10. So on line 10, add up the income, if any, on lines 1A and 2A and enter the total here. Total losses that are allowed from passive activities, add lines 9 and 10, and so we're left with a $1,000 loss. So what's happening here? We have $1,000 of positive net income from passive activities, but we have losses that exceed those positive amounts. And so the losses are limited to our positive amount of taxable or passive income, that is. So we've got $1,000 of passive income. We've got $3,150 of passive losses. We can't have passive activity losses exceed passive income because it can't go into the non-passive bucket. So we're left with $1,000 of losses. So now that we have the $1,000 of losses, what do we do next? Well, now we have to figure out how to allocate those losses across the or apportion them across our activities, right? So on part 7, we allocate the unallowed losses to each of the funds where we had that net passive activity loss. So in column A, we have the loss from Fund 1 and Fund 3, so that's from up here in Part 5. So we've got a loss of $3,000 from Fund 1, a loss of $150 from Fund 3, so we report the $3K and the $150 there. Now the ratio here is the loss reported for each investment divided by the total. So for example, if we look at this figure, the first one, 3,000 divided by 3,150, gives us 95,238. So we have 90. So in other words, 3,000 is 95.238% of the total. So we got the ratio for Fund 1, the ratio for Fund 3, and now we need to apportion the unallowed loss based on these ratios. So the unallowed loss is from page 1, right? Line 3 is our unallowed losses for these activities. So the unallowed loss is $2,150, and we have to apportion it across Fund 1 and Fund 3. So we take the $2,150 times 95,238, and we're left with $2,048. Take the $2,150 of loss, multiply by 0.047, and we're left with 102. So now we have apportioned the unallowed loss to each activity. Part 8, the allowed losses, we report the Fund 1, Fund 3, the total loss, right, from above, 3,000 and then 150, and then the unallowed loss apportioned to each fund. So $2,048 for this one, $102 for Fund 3, and so the allowed loss is the difference. So 3,000 minus 2048, 150 minus 102 gives us allowed losses for Fund 1 of 952, allowed loss of 48 for Fund 3. So why do we have to do this apportioning? Well, because you can't just kind of pick and choose how you want to allocate that loss. In other words, we have 2,150. You can't eliminate the entire 150 from Partnership Fund 3 and then just go into Fund 1 with whatever the difference is. You have to apportion this across all of these activities on a pro rata basis. So we've got the allowed losses here of 952.48, and we know that the overall gain, the net income from Fund 2 is $1,000. So we have $1,000 of net income to report from Fund 2, and then we have losses of 952 and 48 to report from Funds 1 and 3 respectively. So now that all that's done, we go back up to Schedule E, page 2. So we've already covered row C for the active business. That's the $500 there. Now we're in the passive income and loss section for Funds 1, 2, and 3. Well, Fund 1, we were allowed to take $952 of passive loss allowed. Fund 2 had profits of $1,000, so that's the passive income in column H. And then Fund 3, we were allowed $48 of passive losses allowed from the 82, and that's reported in column G. So now we've got the losses, the passive income, the profits. These two are going to cancel out, and we basically have zero in income reported from passive activities for the period. So at the end of the day, all that's left here is the total partnership income of $500, right? So that's the $500 in non-passive income that's left standing because we couldn't use all of the losses from the passive activities to offset all of this flow-through income. So $500 is what's left over, and that's what has to be reported and subject to tax. So ultimately, right, that's going to be reported up on Schedule 1 and flow through to page 1 of the 1040, right? So the income Schedule 1 from Schedule E, there's that $500 amount. So it's just a reminder that, look, you can't, if you have large amounts of losses from passive activities, you need to be careful that you are isolating those against other passive activities and you're not allowing that amount to bleed into the non-passive income, because that's not going to be allowed unless there's some exception that applies or you have a disposition, then it might be permissible. Now, the passive activity deduction worksheets, these aren't required. A lot of tax software will prep these for you, but the nice thing about these is it will track how much losses are being suspended and carried over to next year, and then it will track it on a per entity basis. So Partnership Fund 1, and we have a separate calculation tracking for Partnership Fund 3, right? And then as it does note here, right, did we dispose of 100% of the investment? No. And the reason why we need to track that is because, well, if we did sell everything, then we can have suspended losses that would get freed up. All right. Okay, so that covers it for this video. I hope that was helpful. Any questions, feel free to leave a comment below. And as always, I appreciate you watching and look forward to seeing you on the next one. Thank you.